We have an interesting question here from a subscriber that says they're very confused by the current state of affairs in the markets right now. They're saying that we've just gone through the fastest and most severe global economic downturn in decades, and stock markets are trading like nothing is wrong, and they're asking what they're missing. Thanks for the question. It's a really important one. And firstly, I want to tell you that you're not alone in feeling this way. When things go south like they did with the COVID breakout, it's interesting to see markets trade at all-time highs just a few short weeks after the downturn, equities at least. And even though it's interesting, if you do some additional research, you'll find that it's actually not surprising at all if you have a look at the historical example. There's a very common statement often made by market participants that says the stock market isn't the economy. And this is something very important to keep in mind. In every market, whether we are in a recession or a depression or expansion, there will always be perma-bears and perma-bulls. And the perma-bears are the ones that's calling for everyone to just pack their bags and go home because the world's going to end. And then you have the perma-bulls that says just close your eyes and buy equities because they only ever go up. Now, there's dangers in being either one of these two types of traders, but history actually does side with the optimists, believe it or not. We can take a look at this historical chart of the S&P 500 going back to the 1920s. Now, just for reference, this chart is available on macrotrends.net, as you can see here, and it is currently in a log scale. And actually, let's rather do this as an inflation-adjusted measure just to see the moves in a little bit more context. Now, so going into history, the price is just in the overall macro trend has just always continued going up. Now we can look at a few past recessions as an example, to see that the severity of the downside moves. But the point is that we've always had a rebound, right? So going back to the 1929 one, we had a quick rebound to the upside. Now, yes, the overall trend, many years later, eventually moved lower, but right now, in the context that we are trading, we're not looking at many years ahead. We're looking at what is going on right now, a couple of weeks after the massive downturn. We had the similar type of push to the upside. Had a downturn coming down in 1949 and a push to the upside. Downside, recovery, downside, recovery, downside, recovery, downside, recovery. Now, yes, again, the overall trend of over many years has moved lower, but we've seen this similar type of bounce back in the majority of these cases. We can actually look at this by recession. This will be very interesting. Everybody right now is comparing 2020 to 2007 and to 1929. Now, I agree. If you look at these charts, you think to yourself, what the hell is going on? We shouldn't be trading at these levels that we're currently trading, and look at the examples. But let's remove 2007 and 1929. Let's look at 1990. Similar picture there. 81, similar picture. 80, very, very similar to what we're seeing right now. 73, okay, that had a little bit of a bigger one. Let's remove that for now. 69, 60, 57, 53, 48, 45. You get the picture, is that, yes, recessions often see anything from a 20 to a 30% drop in equities, not the economy, in equities, as we've seen this year. But the bounce back in markets can take anything from years, if we look at 1929 and 2007, to just a couple of months, to maybe just even a couple of weeks, as we've seen the case now as well. So we've got many examples where we've seen the type of reaction we've seen now. So it isn't really a surprise in that sense if we look at the historical examples we've had. Remember that the market is always forward-looking, which is why they look past the current and look towards what is coming. Now, this doesn't mean that everything is just unicorns and cupcakes in the economy, right? There's still a lot of pain in the economy. There is still a lot that can and probably will go wrong. Economies have been propped up by central banks and government's intervention. And if you read some articles on the type of problems facing companies in the months and years ahead, there will be a lot more issues surrounding zombie companies as credit and liquidity issues eventually turn into solvency issues. And on that note, it is possible that the moves lower, that the market moves lower again in line with those things. Of course, anything is possible, but we can still expect buyers to step in with any dips, as they have with any other recession or any other downturn, especially as long as the governments and central banks are there to step in. So we shouldn't confuse the pain in the economy with how the stock market clearly reacts in the majority of recessions. Now, knowing that, in the end, the overall trend is up, knowing that will help you to put things into perspective, I think. There are, of course, those perma-bears out there still calling for, the biggest deleveraging the world has ever seen. If they look at the amount of leverage in the system and look at the amount of debt that governments and individuals and companies currently have, if you look at the demographics, yes, there's certainly reason for them to fear that the mother of all corrections might come into play, but it's only a might, right? It's a big but. They've been warning, to be fair, for that type of deleveraging for decades now. Some of the most influential investors today, without naming names, actually called the 1990 recession a depression. And in hindsight, you should have just bought the dip. If you have a look at the let's go to the 1990s. There's the recession that they had, and it was the start of the biggest bull run in equities we've ever had, barring the one that we've had recently. So, you know, the point I'm trying to make, is saying that always keep in mind that the stock market clearly isn't the economy. Even when the economy is facing massive headwinds, stock markets can still go up, and by quite a lot, actually, if we just look at history. So, again, all this doesn't mean that the correction some people are fearing isn't coming. It just means that we should always remember the major macro trend. And yes, if the everything bubble that we're in right now, if that eventually pops, I don't even want to imagine what that type of deleveraging will look like. Maybe we have a similar type of picture as we had in the 70s and 80s, playing over years on out. We had that move to the upside. Maybe we have another downturn and a move up and a move down. I don't know how it's going to happen. Nobody knows. I think that's the point. This type of move, after we've had the move to the upside, will probably see massive devastation. It might even lead to geopolitical issues that leads to a war. I mean, anything is possible, but right now, not probable, given everything that we've seen, everything that we have to look at right now. I think history is a good enough guide to explain the moves that we've seen right now. So just stick to the process, stick to the analysis, stick to what you know. Yes, these types of things can be confusing, but using history as a guide, it shouldn't be too surprising to see the type of reaction that we've seen. So hope that helps with your question. Any others, please don't hesitate to let us know.